Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. For solicitation or to buy or sell any security, either the host, guests, or clients of either may own securities discussed on this podcast. Welcome to the Special Situations cast. I'm your host, Bram de Haas. It's 16/2/2021. I have a very special guest today, Julian Klymochko. He's the author of Reminiscence of a Hedge Fund Operator. He's the host of the Absolute Returns podcast. He's the founder and the CEO of Accelerate, and he's the chairman of Bitcoin Well. Julian, welcome.
Thank you for having me. Glad to be here.
Well, first of all, I have to thank you because you put out a lot of free and very cool material, like you do an M&A monitor and a SPAC monitor, and you track factor performance. You tweeted a lot about SPACs lately, so thanks. I think it's all great. Why did you become a co-founder of Accelerator? What's the idea behind your firm?
And so I've been involved in running alternative investment strategies, hedge funds for a dozen years. And I used to run, 2 and 20 strategies. So a classic private hedge fund limited partnership for accredited investors, institutional investors. And going through the credit crisis, we had very good returns, positive throughout 2008, 2009, when many other, regular investors kind of lost their shirt as everything crashed. We were running a market neutral fund that was able to do well. And people would ask me what I do for a living, and I'd say I make rich people richer. And I always thought it was unfair that regular people, say like my parents who weren't wealthy, they couldn't get access to these great investment strategies that were actually hedged and could perform in down markets, right? And so the regulatory regime limited participation in hedge funds and alternative strategies only to accredited investors, i.e. wealthy individuals and institutions, pensions, family offices, endowments, etc. And I always thought that was unfair. And so it was always back in my mind in that being able to change that one day. So fast forward a number of years, and in 2018, it looked like the regulatory regime in Canada was going to change, and they're introducing a liquid alternatives regulatory regime, which was like the biggest change ever in the Canadian capital markets. What that allowed us to do is launch institutional caliber alternative strategies within prospectus issued products, such as mutual funds and ETFs. And so I then started Accelerate with the mission of democratizing alternative investments. That is bringing, hedge fund private equity strategies to easy to use, liquid, low cost, and transparent ETFs. It had been something that had never been done before. We invented the hedge fund ETF, in which we utilized both the custodian of an ETF, but the prime broker of a hedge fund. So it was a really innovative concept and structure that was brand new to the market, but it really was able to get around many of the hurdles for traditional hedge fund and alternative investing. That is, traditionally, as I indicated, they're only available to accredited investors. Our alternative ETFs are open to everyone with no minimum investment. And so we're basically providing the tools that everyday investors, investment advisors, et cetera, can get easy access to that endowment style asset allocation, such that a Yale endowment would have access to, but now all investors have access to. Many investors would complain about the 2 and 20 fees, so we cut the fees down by 80%. And then, I've invested in hedge funds, my own hedge funds, and the paperwork was just brutal. And then you put in money to a hedge fund, it takes you 6 weeks to get invested. You got to write a physical check, and then you want to redeem your money. At best, you'll get it 6 weeks after. You put in the redemption paperwork. So the whole thing was antiquated. And we wanted to bring innovation to a sector that hadn't seen any innovation in decades. And so we came with a really exciting business model. And that's a reason why we're one of Canada's fastest growing. In fact, last month we were ranked the fastest growing issuer in Canada out of 40 firms, and it's just an innovative business model that we wanted to pursue.
Sorry to interrupt, but and what you told me at the start, but when did you launch, or?
So the idea for Accelerate started in 2018. We launched our first hedge fund ETFs in summer in 2019.
Cool. Okay. So,
and in the meantime, we had to do all this stuff about forming a business and creating a business plan. It initially started just a light bulb above my head, driving into work one day, and kind of grew from there. Built a team, raised capital, went through the regulatory process and things of that nature.
It's really hard. It takes a long time to launch things. You definitely have some super innovative strategies, I think, and it's very cool that you put them into these ETFs. But how do you deal with some of the drawbacks of that structure? Like, I think like ETFs are like very transparent, so people can see your holdings, which is traditionally a little bit of a problem for hedge funds. And it's much harder to invest in less liquid stuff. Does that bother you, or not so much?
No, we only invest in liquid securities, so we're not doing any private stuff. And with respect to, giving away the keys to the kingdom, on the private hedge fund side, where I used to be, we were running black box strategies. We wouldn't disclose anything to investors, and that presented certain hurdles in terms of investing people's capital. I mean, if I'm giving someone my capital, I want to know exactly how it's being invested, right? So I always thought that was not very smart. And our business model at Accelerate is being the most transparent firm out in the market. And I have given away many hedge fund secrets. If you read I wrote the book on SPAC arbitrage. It's called The Art of SPAC Arbitrage, and it's free on the internet. Anyone can do it. Anyone can learn how multi-factor long-short strategies work, or private equity replication, or merger arbitrage. There's basically step-by-step process that I wrote that investors can do. However, that being said, it's not so easy, right? So they are difficult to operate. It requires a full-time team with tremendous resources, experience, and skill. So at the low fee levels that we charge, at the end of the day, it just makes sense for people to buy our alternative ETFs instead of doing it themselves if they want to save, many hundreds of thousands of dollars in expenses and hundreds of hours per week of work. Like, it's somewhat analogous to having a high performance sports car. Are you going to try to tune your Porsche in your own garage, or you take it to the professionals who can do it the best and most efficiently, because they have the tools, knowledge, and team to do it properly? And that's a consideration. But on the other side, being so radically transparent, there's many hedge funds who have just straight up copied our strategy, which, you got to take the bad with the good, I guess. But, I just saw an article a couple of days ago on Bloomberg saying this hedge fund had all these great results. But I know for a fact that was based on our research, that they don't give any credit for us. But, we know that they're reading our research. We know that they're replicating our strategy. And, that's just the business.
Okay. And then let's see, because I think people can invest their money, they can do great investments, but it's particularly challenging in the special situations or the merger arbitrage, because you always have to come up with new stuff. So you constantly have to research. So it's definitely something, if you have a lot of time, then it's...
it's a full-time gig for sure. You need a team backing you to do this stuff, or you just have no chance. Like, you got to understand there's pros like myself and others with large teams, resources, all the financial data, proprietary data, sell side connections, etc. We're competing in the market. So it's really hard for the individual investor, because they're at such a disadvantage. And one area of disadvantage is like SPAC IPOs. We get access to those, but regular investors don't. They got to buy in the market where they're trading at a premium.
Yeah, I'll have to ask you about that later.
Sure.
I saw, because we've been talking about SPACs already, and this is something I'm super interested in because I think they're so great right now. It's a unique environment. But it used to be different. Can you maybe explain a little bit what a SPAC is and why investors are now so interested in this space and what changed?
So a SPAC is a special purpose acquisition company, also known as a blank check company. So it'll go public, usually at $10 per unit, and the unit tends to be a common share plus a fraction of a warrant. And then the SPAC sponsor, the team putting together the vehicle, they take that $10 and put it into trust, which is invested in short-term treasury bills. And then they go on and have 2 years to combine with a private company, conduct a business combination, and bring them public. So a SPAC serves as a vehicle or conduit to take a private company public. And in turn, or in consideration for that service, the SPAC sponsor gets assigned basically shares in the pro forma entity. And the reason why it's interesting from an investor's standpoint is that if you buy at $10 in the IPO, the sponsor only has generally 2 years to conduct a business combination. And if they don't, then the SPAC liquidates and you get paid back $10 plus accrued interest. And if they do announce a business combination, shareholders get to vote. And prior to the vote, you have the option to redeem your shares at $10 plus accrued interest. So the risk reward is certainly unique. There's no other security like that in the market. So it does present a new asset class that are SPACs. They are now represent 180 billion in market capitalization. That is up 9x year over year. Last year, around this time, there are about 80 SPACs. Now, as of today, there are 409. So the asset class has grown substantially. And one question is, why has it grown so much over the past year? It really hit its stride in July of 2020, where it sort of went gangbusters in terms of IPO issuance. It's really a confluence of two factors. So number one is the consistent returns. And just that assumption was really disproven, I believe, by the Virgin Galactic deal. And so Virgin Galactic was a public equity that was not only pre-profit, but also pre-revenue and not forecasting revenue for a number of years out. And what that stock proved, that SPAC to post-SPAC equity proved, was that there's tremendous inherent demand from public market investors for those sort of early stage opportunities, more analogous to a late stage VC type opportunity than the standard public market security that they got to see. So there's this inherent demand for these types of late stage VC type opportunities that was unveiled just last year.
Do you think do you think there was this preconceived notion, and maybe it was a factor of the boomer generation, where the mantra was really public business needs to be profitable, and millennials think that differently, or is it a product of the times?
Yeah, I think that these things used to be available in the public markets, but then with the prevalence of venture capital and private equity, more and more private companies stayed private longer and longer, and a certain generation of investors just never got access to those types of opportunities. So that assumption was really disproven, and there's this tremendous demand for those types of investment opportunities. Then on the supply side, sponsors figured out that the SPAC vehicle was exceptionally lucrative from a sponsorship perspective. So you had a confluence of those two factors that created this formula for tremendous growth of the asset class.
Right. And so the sponsor is a little bit of maybe a hot topic of hot iron in the SPAC, because it can be like super lucrative, but that comes at a cost and somebody's paying for it. Who do you think that is, and how do you see this evolve?
Yeah, and so the sponsors, so-called promote, they're basically free shares, not quite free, but very cheap shares that they get in the pro forma entity, assuming that they close the deal. Can be as high as 20% of the SPAC. So say it's like a $200 million IPO, they would get roughly $50 million in shares if they complete a business combination and it's not scaled back. Generally, they are scaled back in negotiation or subject to performance metrics and et cetera. And obviously that's taken out of the investor's pocket through dilution. But I don't think it's a huge issue. I think perhaps a sponsor promote will come down over time, but it's no different than investing in a private equity fund or venture capital fund. I mean, they take 20% carry as well, and there's nothing wrong with entrepreneurs getting paid providing a service. Like, you got to realize that the banks take a 5.5% commission. They get paid, the lawyers get paid. Like, people don't work for free, and certainly the compensation is high in SPACs, but thus far, it's been working for all parties involved.
Okay. And do you think it cuts into underwriters a little bit, maybe, who used to do the IPOs?
Or with respect to
like where that money is coming from that is going towards the sponsors?
Yeah, I don't think it's a big issue.
Okay.
So yeah, it's like some people like to talk about it because, especially the larger they get, if you have a $1 billion SPAC and then the compensation is $250 million, that is significant. And some people think that's egregious, but but it's certainly nice work if you can get it. But
there are also some like friendlier structures emerging. Like there's a few famous examples, like the Pershing Square one. And I think Ajax one.
Yeah, so they only had a 10% promote, so that was different. And then you have some that are more performance based. There's a so-called sales structure. I think that's being done by Morgan Stanley. And so there's innovation, and we'll definitely see more of that because it's very competitive. And you need to differentiate yourself somehow. And so some sponsors are differentiating by having less dilution for the investor.
I saw a few ones of the sale, and I don't know what the other one was.
Sale, scale, caps. There's different
acronyms
for a number. So caps was used, I believe, twice. One was with executive partnering, the Paul Ryan SPAC.
Yeah, I was a little bit worried that it may make the space less accessible, because it gets a little bit convoluted, or people don't really know what they're buying if it's all over the place with different types of securities. But
it makes it more complicated for sure.
What do you think about the tontine structures?
It's interesting. We're seeing that every now and then. Actually, one IPO'd today that has a similar structure. It's called Medicus Sciences Acquisition. It was a small medical tech SPAC. They raised $80 million, and they have the same sort of contingent warrant structure where you get the warrant if you don't redeem upon closing. So they offered 1/9 of redeeming. So, just represents more innovation. Do I think that's going to really catch on? I don't know. It's still pretty rare to see.
Yeah, it's like the third one by my count, but you probably keep a better handle.
Yeah, you're probably right. I think there is at least one more.
Okay. Yeah, it's a famous activist fund that I'm blanking on it.
On the Medicus one?
No, the other tontine one. It's famous activist value. I should know it. They did a very famous restaurant campaign.
I'm not sure about that.
Can you maybe talk us through how do you approach investing in SPACs? Because people do take different approaches. I see a lot of momentum strategies, or people that really try to catch the Nicholas. Is that your approach, or are you more of a value SPAC investor?
Yeah, so there's I actually figured out the other one we're talking about before we move on to that. It's GPAC, Global Partner Acquisition 2, also has a contingent right structure where they give 1/6 of a warrant and then a contingent right to receive, another 1/6 post combination. So yeah, you are seeing a small fraction of SPACs get involved. So the way that we approach it, so we run the world's first SPAC focused ETF, which is the Accelerate Arbitrage Fund ETF up in Canada, ARB on the TSX. And the way that we approach SPAC investing is we like to mitigate downside. And so our major concern is, downside protection. So we like to buy at or below $10. If we go back to November, we were buying a lot of those in the secondary market. Fast forward to today, where everything's trading at a premium, we are buying SPAC IPOs. And we really view ourselves as a bridge lender. We partner with SPAC sponsors. We allow them to basically rent our capital for 2 years as they pursue a business combination. And their goal is to announce an attractive deal in which they can attract long-term shareholders interested in that pro forma entity that will buy stock off of us, allowing us to recycle that capital into new issues. So ultimately, we're looking to buy at $10 per unit, so we get shares and warrants. And then once they announce a business combination, we will cycle out of the stock and pass it into the hands of those wanting to be invested in the pro forma entity.
And is it like a quant strategy that you just buy in the, because I noticed that you had an allocation to CCIV, which is like there's a rumor they'll can buy Lucid Motors, and they've gone completely ballistic.
For sure.
Are you just holding that until it combines, or?
Yeah, so we have a systematic strategy and we're widely diversified. Like we own roughly 150 SPACs in the Accelerate Arbitrage Fund currently. So we do provide that diversified exposure. We find from our analysis is you never know exactly, which sponsor or which mandate is going to do the best deal. I always think it's funny how we had all these cannabis SPACs. None of them announced a cannabis deal. They all pivoted to electrical vehicles, space, whatever the hot story is. And then some of the most under the radar SPAC sponsors gave us the best deals. We had a big win through Northern Genesis and Lion Electric. That one was fairly under the radar. Another one was the Diamond Peak Lordstown deal. They actually had a real estate mandate, ended up doing an electric vehicle deal, very under the radar. And both of those ones we were able to buy $10 or below and exit around $30, which is obviously great when you have that mitigated downside through the redemption option at $10 plus accrued interest. Then with respect to CCIV, Michael Klein, he runs Churchill Capital, the sponsor of CCIV. He has now, I think at least a half dozen. Yeah, so he IPO'd Churchill Capital Corp 6 and 7 last week. So he currently has 5 SPACs in the market, definitely capitalizing on the current environment. And we own CCIV since around its IPO in the summer. And yeah, we hold it until they announce a business combination. CCIV is unique in that there are these lucid rumors that have been swirling around in the market over the past couple months, and the stock has actually gone from below $10, which is where we were buying it, to now $50, which is just crazy for a pre-deal SPAC. So it was one of our largest positions, and it grew to a by far the largest position in our portfolio. So we had to override our systematic process just to actively scale that back, because we usually wait until there's a definitive agreement, but it's approaching like a 5% position in our portfolio. So we did have to actively scale back that position. However, I do got to disclose that we still do have a position in CCIV as of today. So looking forward to them actually announcing the deal and being able to analyze it.
Yeah, that would be very interesting. And do you think actually, like, like a surge like this, does that hurt like the potential for the deal to actually come to fruition?
Yeah, perhaps. I mean, because the company's going to notice that and realize that they don't want to leave too much value on the table. But on the other side of things, most or basically all high quality SPAC business combinations are announced with a concurrent PIPE financing. So private investment in public equity at $10 per share. So the private company, in this case Lucid, needs to have a sizable PIPE financing, and that really anchors the valuation, right? So public markets are underwriting some incredible valuation, but the PIPE investors, they are they're institutional investors, long-term money investing hundreds of millions of dollars. They have a perhaps more rational view, and they will underwrite a equity offering, a PIPE financing at the $10 per share mark. And so that kind of grounds the valuation to something more sensible in the context of the market. But the stock is free to trade where the stock wants to, and certainly CCIV has turned highly speculative as of late, certainly.
For sure. And is there like some kind of creative solution for Klein and to like solve that issue? Because that's almost sounds like it could go down on a deal, like, or actually an announcement.
Yeah, and we have seen that, so I wouldn't view that as too shocking. I mean, like, the stock price is largely outside of their control. I mean, they can't control what rumors get leaked. They can't control where speculators want to trade it. So, all they can do is sign the deal, and deal leaks always can put a deal in jeopardy, and that's just a risk in deal making.
Okay. And I think it's a great reason to go through a fund, is that you can get these pre-IPO allocations, because I currently I can get them at $10, and I used to get them in the 9 to 10 range, but then they weren't as exciting. So
yeah,
it's a good trade-off. But do you think it's for like an individual investor, it's ever worth to pay like 13 per share for a really good sponsor, or
no, like I'm not too keen on people doing that. I mean, that introduces pretty significant downside risks, and I've seen investors get burned by that. So definitely try to approach the asset class with discipline, and don't pay too much of a premium.
Yeah.
Right, because currently premiums are at an all-time high, and it's at a bit of frenzy, and I expect that to correct at some point, and you don't want to have too much of a drawdown when that occurs. So definitely be disciplined when trading in SPACs, and if it's a pre-deal SPAC and you're paying a massive premium to cash, be careful with that, because in my opinion, that's playing with fire.
Yeah, I really agree, and I think if you stick to the discipline, you really get to profit from that asymmetric nature of this SPAC structure.
Yeah, and you really can't expect them to go up 50 to 100%, to go to like $15, $20, $30. I think that's unique to the current market environment, and I don't believe that's sustainable.
Right.
I think historically, if you had a good SPAC deal, go to like $12 or $13, and that's a big win, right? So, something
sure.
like
have
this Lucid deal at $10 per share, and then it trade to 50. It's like that's crazy.
Yeah, I remember like in March, I just bought a bunch of SPACs because they traded off a lot, and I don't even remember which ones they were, but I'm not going to look it up, because I'd probably be really depressed.
Yeah.
Because I sold them later when they were like near NAV, and I was like,
yeah,
it's great I did great on these.
Yeah, exactly. And as you indicated, we go into a bear market, most of these trade down to a discount. Like I remember in April, we were buying a bunch at 970, 980, 990, and we at that time there weren't very many IPOs at that time, so we're participating in the odd one, but it was just a great time to be investing in the market, because you could buy pick of the litter at a discount.
Yeah. Hey, and you thought like the Liberty Media SPAC was like a signpost for the industry? It's well, John Malone isn't personally involved, but Greg Maffei is.
Well, yeah, Greg Maffei, he runs the SPAC. It is sponsored by Liberty, and so you know that John Malone's controlling the purse strings, and he's like the puppet master, right? And so Liberty is sponsoring it, and John Malone and Greg Maffei, absolutely gold-plated reputation, perhaps one of the best, if not the best, management team and value creators active in the market these days. And for me, that was really a seminal event in the SPAC market because it really shut down a lot of criticizers and haters of the asset class. Because once they saw John Malone get involved, they just had nothing bad to say anymore because he legitimized the asset class and he brought it a lot of respect, in my opinion. That being said, commenting on the SPAC, at it trading at a 35% premium to its cash value, I would certainly warrant some caution and discipline on that because it is pricing in very, very rosy expectations. So I'm not saying that it's going to turn out bad or anything, but the higher it goes, the less skewed in your favor that risk reward profile is.
Yeah, I would love to buy it, but so far I haven't. Um, how does it go with like the pre-IPO allocations? Because I've heard that's real hot too right now. That's hard to get like chunks of SPACs.
Yeah,
How are you working that, or does it help you if you're a huge player? And are they like maybe not too fond of ARBs because you're a temporary investor?
It helps if you're Citadel or Millennium. Right?
Okay.
That's kind of your best chance of getting allocations because, I don't think they're getting scaled back. They're still taking down kind of 5 to 7% each on every IPO. And then you have, other funds that are unfortunately just flipping on the first day for kind of that 5 to 7% rip. But it has become extremely competitive over the past 6 weeks. I'd say, something similar happened in the late summer, not as competitive, but our allocations started getting, taken back. Like early
So
summer,
is it
we're
about
getting
relationship with like the underwriters?
and so you need to have accounts set up with all the underwriters, and obviously, good relationship there that built up over time. And in the summer, we're getting good fills, 100% on all our orders. Then late summer, that started getting scaled back. And as that happens, the dynamic is that it's happening to other funds too. So people start increasing their orders. Like if you're going to put in for, call it 100,000 shares and you get 20,000, then next time maybe you'll put in for 200,000 or something like that. So orders start becoming artificially larger. And then fast forward October, November, there's a bit of a drawdown such that the SPAC market in aggregate went from over a 15% premium to flat. So there's no baked in premium. And at that point, we're getting back to like full fills on IPO allocations. And in fact, there's a period in early November where all SPAC IPOs, the units, 80% were trading below, at or below $10. So at that point, we weren't even buying any IPOs really. I mean, we were mostly just buying at $9.90, $9.95 per unit in the secondary market. I remember, buying great units like Forum Merger 3 and, some Bill Foley SPACs at or below $10, which I thought was a phenomenal deal. And then the past 6 weeks, you've had a ton of new hedge funds come into the space just looking to flip these. And so now each deal is 10 to 20 times oversubscribed. Like if it's a $200 million SPAC deal, the underwriter will get $2 billion in demand, and they'll have to see how they can sort of piece that out. So it's gotten incredibly competitive, and all I can say it's tough out there, but it's a unique environment.
It was immediately like a drawdown when on the GME craziness.
Yeah, I was expecting that to actually have a better effect, i.e. to have some of those large hedge funds pull back, which would have created a good opportunity. But yeah, unfortunately, that didn't really come to fruition.
Okay, yeah, I did notice like that SPACs pulled back like quite a lot. Like
yeah, Well, a
Right.
little bit, but unfortunately, it wasn't what we're looking for.
No, yeah, okay, maybe there's always better drawdowns.
Well, I mean, SPAC premiums are at a record high on average 26%, and they went down to maybe like 22, which is still exceptionally high, right?
Right. Yeah, sure. But I mean, they're also popping at exceptionally
Yeah,
high.
less. Yeah, they went from going up 7 to 8% on the first day to more like 3 to 5%. But
Yeah,
still, historically, they haven't done that. Like I remember when Chamath's IPOB came out, I think it traded at 10.10 the first day, and I'm like, well, we don't want to pay a 1% premium. And now he does an IPO and it trades at a 30% premium. Like it's crazy.
yeah, but the volume of like the SPACs has also gone up a lot, and you
Oh yeah, for
you
sure.
already mentioned like that the size already increased. So
Yeah.
isn't that like slowly putting a damper on the market, or?
Well, I'd say as the supply has increased by an order of magnitude, the demand has only increased exponentially. It's somewhat, yeah, it's somewhat counterintuitive, but as supply has increased by 150 billion over the past year, demand has increased by like 500 billion. When you put it in that context, you don't really know where the money's coming from, but many people just blame the Fed and forget about it.
Yeah. Yeah, well, I'm really excited that so many companies are coming to the market again, because we've really seen a thinning of public markets.
Oh, for sure. Like US markets have gone from 8,000 publicly traded companies to 5,000. So I think even if you're a hater of SPACs and talk trash about them, you can't deny that it's great that we're getting more and more public listed companies. And if you're bearish, then you should be happy. You should be celebrating, because then it gives you more companies to short sell. And if you're a growth investor, like it's positive for any investors, like a bull or a bear. So I don't think anyone should be complaining.
No, sure. Yeah, definitely in a few years, so maybe, awesome opportunities. Let's see, like the Liberty Media SPAC is so interesting because the sponsor is held in, or the promote is held in a publicly traded company.
Yeah, FWONK, I believe, the Formula One tracking stock, which this makes it even more convoluted, but.
Yeah, but it's also kind of cool to be able to get in on a promote. Or
yeah, I believe there's another public company. They did the. I'm just pulling it up here. The LMAO SPAC, LMF Acquisition Opportunities. We actually own some of this in the Accelerate Arbitrage Fund, but I believe their sponsor is publicly traded as well. I don't follow the company too well.
Okay.
I just follow the SPAC.
Yeah, and the Pershing as the warrants in a closed-end fund is actually trading at a huge discount.
Yeah, and so that's a really odd one, because if you look at PSTH, the SPAC, it's just trading at an incredible premium of 57%. So SPAC investors absolutely love Bill Ackman. It's just it's insane, because that's a $4 billion SPAC. And so they're ascribing like that his idea is worth more than $2 billion above that. But then you look at his closed-end fund, massive double-digit discount, and closed-end fund investors hate him. So like, what is it? There's these two. There's this dichotomy in the market where one group of investors love him, one group of investors hate him, and it's created this massive inefficiency that you just can't explain.
Yeah, people really rooting for him getting Stripe or some super high-profile tech company, I guess.
Yeah, who knows?
It's not really a style.
It's been public since July, and he has until July of 2022. So, Bill, the clock's ticking. We don't have a position, but will be interesting what he finds, because he's really sort of painted himself in a corner raising $4 billion, because typically a SPAC will target a deal 3 to 6 times the IPO proceeds. So you're talking about a deal that's in the sort of $12 to $24 billion equity value range. Kind of limits his prospects.
Yeah, that's true. There's not many targets. You can almost go through them.
For sure.
Yeah, so maybe if you have a little bit of time left, you're also involved with Bitcoin. Yeah, actually, it's part of like you offer like a wide range of strategies through your ETFs, and in at least one Bitcoin is an allocation. How are you thinking about future of Bitcoin, allocation towards it, those big picture things?
Yeah, so I've been a long-term bull. Bitcoin, obviously, like everyone, didn't get involved as early as I wished. I got involved in really early 2017, and I launched the first Bitcoin fund in Canada in summer of 2017. And I believe at the time it was roughly $2,300 per Bitcoin. And you know, ever since, I've liked the asset class. You cannot deny its performance. And even if you're skeptical of, you know, the underlying technology, which I think is absolutely genius, you know, the blockchain technology and the way that the system works, where, you know, it's this store of value that cannot be manipulated by governments in an environment of just tremendous monetary and fiscal stimulus, where we're rapidly seeing the you know, fiat currencies depreciate. I think that digital store of value, so-called internet money, is digital gold. It's a tremendous asset that investors now have access to, all investors, not just institutional investors. And it's a unique asset class in that the roles have been reversed in this one. Typically, it's institutional investors that get these exceptionally performing asset classes, and retail doesn't. But Bitcoin is the one where retail got way, way before institutional investors got. If you look at the quantitative metrics behind Bitcoin, 1 year, 3 year, year to date, 5 year, 10 year, it blows pretty much all other asset classes out of the water, not only on an absolute return basis, but also risk adjusted. Yeah, it is highly volatile, but take that into account, and its Sharpe ratio long term is still like 1.7, which is just crazy. And you are seeing, I continue to be bullish, even though it's around 50,000. I've been bullish as it gone up 20x, and I still am, in that you're now finally, as it approaches $1 trillion in equity market capitalization, you're now finally seeing it become accepted and legitimized enough that institutions can start buying. So first was MicroStrategy, and Michael Saylor is an unapologetic Bitcoin bull, a maximalist.
You could say that.
He has earned MicroStrategy shareholders billions of dollars from his move into Bitcoin. Now, with Tesla doing it, I think that kind of blows the lid off. Now, Bitcoin exposure is in the S&P 500, and the S&P 500 is tracked or benchmarked by like 11 trillion in assets. It's the most popular index in the world. So whether you like it or not, you probably own Bitcoin at this point. Harvard owns it, Yale owns it. It's only a matter of time before more and more institutional investors, where it is a default allocation in a portfolio. In terms of allocation, if people are interested, I typically advise, you know, maybe 1 to 2% allocation, because it is volatile. It can go down. You should expect it to go down 80% at some point, because that's what Bitcoin does. And thus far, it has gone to reach new highs. So definitely have an amount that you're not going to, you know, get to the point where you feel compelled to sell in a bear market. You need to have the right position size where you can stick with it through thick and thin. As you indicated, I'm involved in Bitcoin from a number of perspectives. The first, we do offer a product at Accelerate. It's called the Accelerate One Choice Alternative Portfolio ETF. It's the first diversified alternatives portfolio solution that we provide 6 alternative asset classes, 10 alternative strategies, and 1 easy-to-use low-cost ETF. Trades under symbol ONEC on the Toronto Stock Exchange. That does have a 10% allocation to Bitcoin as of today, the only Canadian ETF with Bitcoin in it. We also filed recently a prospectus, a preliminary prospectus for a Bitcoin ETF called the Accelerate Bitcoin ETF. Proposed symbol is ABTC. However, that is still subject to regulatory approval. Not much I can say above that. And then I am chairman of a Bitcoin ATM company called Bitcoin Well that has a proposed going public transaction that is also subject to approval. If investors want to learn more about that, they can just Google search Bitcoin Well, or our offerings on accelerateshares.com.
Cool. Um, yeah, and so you're real bullish on the future of Bitcoin. Are you a believer in the entire crypto space, or are you is it called a
No,
maximalist? If you
I like Bitcoin. You look at the metrics. It is the leading cryptocurrency. I believe it will always be so. One reason I like it is it has very low correlation to traditional asset classes and other alternative strategies. And that's really the bedrock of diversification. From a theoretical portfolio, the portfolio and asset allocation standpoint, you want uncorrelated return streams. Bitcoin presents that. So if you're a rational investor, you look at the numbers, it makes sense to include in a diversified portfolio. Stocks that only hold portfolios that only hold two asset classes, stocks and bonds, in my opinion, are incredibly risky. And people complain, oh, Bitcoin's too risky. But in fact, adding a small allocation to Bitcoin actually reduces portfolio risk by adding that diversification, that low correlation. So that is something that most people get wrong about the asset class. In terms of other cryptocurrencies, I do see value in Ethereum, but the vast majority, I think, are just of dubious value, and I would never own them. So throughout my investing career with respect to cryptocurrencies, always been focused on Bitcoin, but I have owned Ethereum in the past, a long time ago. I do not anymore. I only own Bitcoin these days, and I'll probably stay that way. I do see merit in Ethereum, the use case. It is useful, the smart contracts. But other than that, yeah, I'm fairly skeptical of any other cryptocurrencies in the market. I don't really see the purpose of any of the other ones.
and how there are like not a lot of like blockchain companies that are publicly traded, or they are a little bit low quality.
Yeah, I'd say so.
Do you think that's like a product of the whole ICO thing, that they've gone off on ICO side chains, or
No,
are they still to come?
I think it's the dynamic where a few years ago you had many low quality offerings just looking to capitalize on the hype, specifically in 2017. So a lot of low quality companies went public then. However, they went boom and bust. People learned the lesson, and now they're much more selective. So you're seeing a new crop of companies go public that are of higher quality, sustainable, profitable, growing, a rational long-term business that is actually an attractive investment opportunity. So I think that there's a key differentiating factor with respect to the new crop of companies going public. For example, one rumored to be going public is Coinbase. I mean, no one can deny that, that's not a high quality company.
For sure, that would be super interesting. And there is like a tiny company which I think has an indirect interest in Coinbase. But that reminds me, like, why didn't more they could SPAC like a lot of those, right? And we've seen a few, but not.
We have seen a couple,
Terras?
specifically VPC Impact and the Backed deal. That was announced in just last month.
Yeah.
So there's that.
People are really excited about that one, I think.
Yeah, and we had a position in that one. We have divested that position, but it was certainly a winner. Yeah.
Cool. Julian, I really want to thank you for being on. It was very educational. Where can people find you, or your firm, if they want to learn more?
So I'm fairly active on Twitter. You can follow me there at Julian Klymochko. We do have a podcast, Absolute Return Podcast. Check that out. You can take a look at our website, accelerateshares.com. And that is mostly it. Yeah, social media, website. And
you are really active, and also on a lot of SPAC tickers, M&A tickers, I think, too.
Yeah, for sure.
So everybody, thanks for watching, and hope to see you next time. Please like, subscribe, share. Thank you very much, and bye-bye.